Is the mortgage industry broken? That's an honest, real question. Sit with it. Let it sink in. Think about this. We have record numbers of realtors going on payroll. Builders are going on payroll. We have crazy sign-on bonuses with these outrageous multi-year clawbacks. LO compensation rules, what do they even mean? Do we even follow them? Heck, who even knows what they're supposed to be? Based on my experience, my observation, very few do. And then we have lawsuits galore and a CFPB that for the most part has no teeth, has no bite, is nothing to fear. Could this be a turning point? You're going to have to tune in to find out. But this is serious business, and we're going to be doing a deep dive. Check this out. Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and with me from the T-Lot team is my producer extraordinaire, the one, the only Karina Mojica. Hello. And along with Karina and I is the man, the myth, the legend. He is Marketing Mike, a.k.a. Mikey, Ricky, Vinny, Bobby, Mike Siciliano. What's going on there, Rocco?
What's up? Yeah, no, but then he threw in the Bobby, so it's like Ricky Bobby.
It's Ricky
I can't
Bobby.
argue with that.
It's kind of
Let's
like
shake and bake today.
Yeah. He's kind of like if F1 had an Italian version of Ricky Bobby, it would be Mike Siciliano. It'd be Marketing Mike. Yeah. Y'all, I give him shit because he has 4 names. It's Michael Vincento,
Michael
Rocky
Vitucci.
Is it Vitucci?
Siciliano.
Yeah. Mikey, Rocky, Vinny.
Yeah.
He's my boy.
Stallion.
The Italian stallion. I love it. Is that what you make your wife call you? Oh, yeah. Karina's like, la, 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 la. That's gross. For those that don't know, our producer, Karina, her big sister is actually Mike's wife.
Yep.
It's a weird dynamic that we have here. It's a dynamic that's working.
Yeah.
Like, this is fun.
Yeah, this is cool.
Like I thoroughly enjoy, like, no offense to John Coleman, but I like having Karina on set.
Yeah.
I like having her on mic, on camera, producing the show.
Agreed.
Yeah,
you
you bring an element, and then,
thanks, guys.
you're very welcome. Yeah, it's like we did bring baby sister with us, Yeah. It's like little sis is with us, and but she does do a ton of work, both setting up and doing all of the edits behind the scenes.
A lot, quite a bit.
Yeah, under your direction and all. But we have a I'm gonna call this a controversial episode in front of us. Like, this is I hope I don't piss off too many of my friends. But it's a moment where I'm like, but I don't care if I do, because if you're not seeing this and you're not feeling this, maybe we don't want to be friends. I don't know. Like, I'm cool for debate. I'm cool for someone having a different perspective, a different point of view, but I'd be a hard time for somebody to like not acknowledge the things I'm going to explain to the two of you today, and in hopes that you ask real good questions about like, hey, what was it like before this? Or what is it supposed to be? But I have this fear, and I promise you, my courage didn't come from liquid.
This is heavy.
My courage came from, I've been around executives recently on retreats, doing some closed door behind the scenes meetings. And it's come up in almost every meeting. Are we broken? Or one guy even stated, we are broken. Mortgage industry is broken. And this guy even admitted that, and I'm a part of it. And then he goes, and I don't know what to do about it. Right? Meaning, I'm a part of it, and I'm not planning on not being a part of it until something finally breaks. And that gave me the courage to do today's episode, but it also kind of gave me a perspective that, because I was always at a loss, and now I've just realized it's going to be this way until something breaks. So we want to talk and do a deep dive. Like, the mortgage industry is being sued multiple times over, right? The real estate industry was just sued.
What's the latest on that? I'm out of the loop.
Well, you had the NAR Commission settlement lawsuit.
Oh,
right.
Yeah,
Everyone knows about that. Where, and there was one particular law firm that was pretty involved. Well, guess what? There's one particular law firm who's pretty involved in Veterans United being sued, Rocket Mortgage being sued. They're involved in Zillow being sued.
Interesting.
And that same law firm happens to be the same law firm that helped sue the National Association of Realtors.
Wow.
Yeah.
Wow.
Like, this is like legit shit. I don't know if you can settle your way out of this. I don't know if this is going to like withstand not going collective action or class action. I don't know if it's going to withstand it, finally making national news. Mm-hmm. And man, the minute it makes national news, I'm going to tell you what happens. Every state regulator feels like they were just one-upped by a private attorney, at which point the scrutiny that's going to come from state like attorney general's offices, mm-hmm. Oh, that's a havoc that's going to be wreaked on this industry, or could be. That's probably 50 times worse than if we had a CFPB that wasn't defanged and was actually out doing what it set out to do.
Yeah.
Okay, so we're going to talk about these lawsuits. We're going to get into loan officer commission. We're going to get into WTF. Are we really putting realtors and builders on payroll? We are, by the way. Is this how the industry was? No, it wasn't. Is this how the industry should be? I can't imagine it should be. Or better yet, figure this one out. We as an industry, as a loan originator, the men and women that we support, the industry I was once highly a part of as an originator, we have never made this much money per transaction and done this little transactions per originator. So executives look at us saying, you're overpaid and lazy. You're doing less transactions, less units, and we're paying you more money than ever. And these companies, whether you're a wholesaler, you're a bank, a credit union, or a retailer, they're also saying under their breath, behind the scenes, and we take all the risk.
Yeah.
We take all the risk. But you make the most net profit and you're doing the least amount of transactions that you've ever done per month per person.
Yeah.
How long are we going to let this happen before something finally gives? So these are all the topics and subjects that we're going to lump into one. We're going to unpack each of them individually, and we're going to turn into a 30-minute episode.
Yeah, I love it.
All just to make you say, right? We're not going to solve all the world's problems with this, but we're going to bring it to your attention to make you aware of it in hopes that when everything starts to come to a halt, when you see massive changes, you're not cold clocked. You're not sucker punched. This doesn't come out of left field. You're like, this moment's finally come. Yeah, we saw it coming. Yeah, I knew that this journey would end at some point. I'm cool. I'm ready for it. And whatever shift.
You'll say, you know what? Dustin told me.
Dio told me.
Dio said this was going to happen.
Nostradamus.
Yeah. Oh, I like
Nostradamus.
Like, oh, yeah.
Yeah, I'm not even Nostradamus. I'm just like, guys, open up your fucking eyes.
Yeah.
Like.
Well, let's jump in.
Well, let's jump in, but.
Let's hear from today's show sponsor first.
Go for it. Y'all, something big is happening at Lower Mortgage. And if you're paying attention to this industry, you've probably noticed. In just the last month alone, Lower has added some serious horsepower. We're talking top producers representing over $350 million in volume. These aren't rookies kicking tires. These are heavy hitters who've done their homework and made the move. That should tell you something. On top of that, Lower just acquired Movoto, a top 5 real estate portal with over 150 visitors just last year. Before that, they brought in Neat Labs, and now they're launching Lower OS, a next-gen mortgage platform that's cutting loan delivery times down to 10 days. This isn't a company standing still. Lower doubled their volume last year, and they're projecting another 40 to 50% growth this year. The best in the business are taking notice, and they're voting with their feet. Here's the reality. The companies that are going to win in this market are the ones investing in technology, building real infrastructure, and competing at scale. Lower is doing all of that. They're going head to head with the Rockets of the world, and they're built for originators, not against them. If you're a producer who wants to be a part of something that's actually going somewhere, not just surviving, but growing, this is the moment. Lower Mortgage, the momentum is real.
And we're back.
All right, so we're back. Where do y'all want to start? Like, Karina, I've just spewed a bunch. What do you like? Okay, I'm talking loan officer compensation. I'm talking about mortgage companies being sued. I'm talking about the mortgage industry is basically putting realtors and home builders on payroll. And we are massively just violating loan officer compensation rules.
I want to hear why the mortgage businesses are getting sued. Is that what you said? Mortgage businesses?
Yeah.
That's a good one. Let's start there because I'm light on that too. Like I don't know much about that.
You're on that too. So I knew I was going to butcher this law firm's name. So like I had to write it down real quick so I wouldn't forget. Hagens Berman. Right. Okay. So Hagens Berman is the lawsuit. The lawsuit. It's the attorneys representing the plaintiffs who are suing.
The same one from the NAR.
Same one from the NAR. And if you go back, these people have been involved in these types of consumer lawsuits for 2 decades, if not longer. Right. Yeah. So,
but it's a real lawsuit. Like these aren't frivolous. Like they're
legit.
They have grounds.
Yes.
Okay.
Yeah. So they're suing Zillow, they're suing Rocket, and they're suing Veterans United. Well, there's rules in the mortgage industry. There's regulations like that prevent us from, like, Karina, if you're a realtor and you refer me Mike, who needs a loan, I can't then give you a $10 bill and say thank you, right? That is a quid pro quo. I cannot pay you directly for a referral, right? And it's RESPA. It's Section 8 of RESPA, the Real Estate Settlement Protection Act is what it stands for. It's from like 1972, so it's been around for a hot minute. There's also rules that state that, you know, I can't have unfair advertising practices, right? So unfair and deceptive advertising practices called UDAP. And it's guarded. The relationship that lenders can have with real estate agents and what service providers are willing to or able to, I should say, compensate is highly regulated. It should be, and it always has been up until, I don't know, the past 5 or 6 years.
Yeah.
And you have right now, especially with like technology advancements and the size of companies. Like you look at Veterans United, it's a massive company. You look at Rocket, massive company. You look at Zillow, massive company. And these companies control data, they control technology, and what they're trying to do on purpose, it's a business move, they want to control the consumer from cradle to grave, right? The minute you turn 18 and you think you want a checking account, to the minute you die and you're paying off your 7th mortgage, Rocket wants you to be in their ecosystem. Zillow wants you to be in their ecosystem. So what they're doing is that Rocket and Zillow and even Veterans United, they have a lot of consumer leads coming to them. Consumers reach out to them, and consumers need help with mortgages. If you're Rocket, they need help with credit cards as well, and they need help with finding real estate and real estate agents.
Yeah.
Well, Veterans United has been giving leads to realtors, and Veterans United was doing this, I'm sure, legally. I've never worked at Veterans United. I don't even know anyone over at Veterans United. But I'm just going to paraphrase this the best way that it makes sense to me. Veterans United in this case was generating leads through their marketing and their advertising, and the leads were for mortgage as well as for real estate. Veterans United, I'm sure, has the legal right to partner with real estate companies and hand them a home buyer and say, hey, when you help that home buyer buy their house and you get a commission, you owe us 35%. Okay, cool. And then obviously Veterans United was also trying to do the mortgage. All of that by itself, no big deal. However, as the lawsuit claims, and again, I paraphrase, Veterans United is going to the realtor saying, you know what, Karina? We've given you 5 buyer leads over the past 10 weeks, and you've closed 3 of them, but only 1 of them actually used our mortgage company. You know what, Karina? That's bullshit. You need to be better. I'm going to quit giving you leads because you're not steering enough business
in your direction,
in my direction. Well, that's what you can't do. You have anti-steering laws in place for that reason. Same thing, same type of lawsuits being pushed onto Rocket. Same type of lawsuits being pushed onto Zillow. Zillow and Rocket have similar partnerships with real estate agents. And it's all well and good until that real estate agent isn't pushing enough business to their mortgage company, at which point they say, well, we're going to go find someone else who does a better job. And it's a slippery slope because I would tell you, as a lender myself, as someone who coaches loan officers, I want partnerships in the community where they refer the hell out of me because I'm trustworthy, I'm experienced, I'm accountable, because I believe there's no such thing as a one-size-fits-all mortgage, because I'm going to be the guy or the girl who advocates on behalf of my buyer when they're placing an offer so that my buyer's offer gets accepted and my buyer doesn't have to overpay to actually get the offer accepted. Because if you're a home buyer and you're in a competitive market and your lender is unknown or your pre-approval is weak, there's a good chance the only way you get your offer accepted is by paying top dollar. Well, if I'm a great lender, I want my realtor partners in my local market to refer me, and honestly, just me. Like, so I get it. I get why a Zillow or a Veterans United or a Rocket would potentially want to be like, hey, look, we kind of have this really cool ecosystem. We work really well together. We should be able to try to control the transaction to give the consumer a better consumer experience. But what if that means the consumer took a 0.25% worse interest rate? Now they're paying $72 more per month for the next 3, 5, or 7 years until they pay off that mortgage by either selling the house or refinancing it. Very few people keep their mortgage for more than 7 years. Or what if they paid an extra $10,000 in closing costs because they went with, again, Veterans United or Rocket or Zillow? I'm not saying they would, but the lawsuit claims what if they did, right? So that's the lawsuits that are happening right now. And we didn't have that before. Like we didn't have that type of, if you don't do this, we'll take you off our platform. Right. If you don't wear our colors, if you don't, get on your megahorn talking great about us, then we'll just kick you off and find someone else who will. And I'll be honest, I, in a way, like these types of lawsuits because it's a great check and a great balance, right? We need those checks and balances in general. It's going to be interesting to see what transpires, but this could be the tip of the iceberg moment, or it could be one of those moments that they settle, people get paid, and they move on.
I want to understand this better. I'm sorry. I want to follow it so that I can ask better questions.
Well, okay.
So, Rocket. Let me use Rocket. So we're upset, or the lawsuit. Rocket has basically a monopoly over this financial ecosystem that has to do with me getting a loan as a consumer, and they have, they have the realtors in their ecosystem already. So they're the referral and the whole transaction is owned by them.
But so,
and we're saying that's not, we don't.
Well, here's what we don't like. Rocket is generating all of this consumer interest in real estate and mortgage. Rocket then has a chance to refer a real estate agent, a home buyer, or a home seller. And typically Rocket wants money from that realtor for that. And that's okay, right? In the real estate world, you are allowed to pay for leads. You're allowed to pay split commissions. But what Rocket is being alleged is they're saying, Mike, unfortunately, when we send you a home buyer, they're not being sent back to us for their mortgage. They're going and using this bank or this credit union or this local mortgage broker. Mike, we're done, dude. We're done.
So they had a partnership to begin with?
Well, it was a partnership, but it was like this, Karina. If I'm Rocket, I'm basically selling Mike this home buyer lead. Mike's paying a part of his commission to me for that lead, or part of his marketing budget is to pay for that. But then I'm cutting Mike off because I said to Mike, I gave you 5 buyer leads. By the way, Mike paid for them. And none of those buyers used Rocket Mortgage. Dude, we're done. Or how about this? What if 90% of your buyers, because the lawsuit's going to allege this too, what if 90% of your buyers all used? It's like, wow, Mike, are you steering? Right? So you're wearing your Redder is Better hoodie. Right? Shout out to our friends over at Redder. If you Reddered, right? A realtor's production. An average great agent is doing 20, 30 transactions. Of those 20, 30 transactions, 10 to 15 are home buyers. I promise you, if you pulled it up, there's not one lender getting 90% of their business. There's not. But the lawsuit alleges what happens when we go into Redder, we look at how real estate transacts from Spokane to Key West and everywhere in between. And all of a sudden, we have these anomalies. If you're partnered with one of these companies that we're suing, instead of a third of your business going to one particular lender, even half, right? Some of my coaching clients, they have realtors that half their business is going to...
Well, like UWM or like...
Well, that's different.
Okay.
Well, that's a little bit different. That's a whole nother ball of wax. Maybe we can unpack it. Maybe we can't. But it's just in general. We have coaching clients that work with realtors who are top producers, or coaching clients are top producers. And when we pull their data, I can see that Mike works with Judy on 50% of her home buyers. That's a lot. 50% is a lot. But you know what's a lot more than 50%? 90%. So those are the lawsuits that are transpiring.
Yeah.
And we haven't really had to deal with this. But the problem is this. If that's happening at the highest level, then what are we at the more local levels trying to do? What if one trip could elevate your personal brand for the entire year? On April 14th and 15th, our friends over at First Home IQ are taking loan officers to Washington, D.C. for the MBA's National Advocacy Conference, which happens to be my favorite event of the year. But let's be clear, this is not about politics. This is about an opportunity for leadership and visibility. Only 1 in 8 next-gen buyers trust loan officers, and 6 out of every 10 feel the housing system is rigged against them. Building trust happens locally in how you show up, educate, and listen. But it only happens nationally when you show your market that you're on the Hill advocating for policies that protect them. Here's the game plan. Weeks before going to DC, you're going to be creating content. The content's going to be about why you're going, why affordability matters in your market, why first-time home buyers need better solutions. Now, when you're in DC, First Home IQ is going to be bringing in a professional video and social media team. You're going to walk away with video reels, behind-the-scenes content from Capitol Hill, direct-to-camera footage, content that positions you as a trusted housing leader in your state and local community. And here's the strategy. Most LOs talk about affordability. Very few show up on Capitol Hill to fight for it. When your referral partners see you advocating face-to-face with lawmakers, that signals leadership. Consumers trust individual professionals more than institutions. The mission is clear. This is a pivotal year for home affordability. It's a pivotal year for First Home IQ's mission, and it's the 250th birthday of America. We're aiming for LOs from every state advocating together for housing affordability and sustainable home ownership. You'll meet lawmakers. You'll learn how policy works. First Home IQ is going to give you the talking points. You'll know exactly what to say and why it matters. The visibility you create before, during, and after DC will reach your local market in a way no ad ever could. Washington needs more LOs in the room. Your state needs representation. Your borrowers need advocates. And your personal brand deserves elevation. This is a movement. This is your chance to sign up. Join hundreds of mortgage professionals. March on Capitol Hill. Go to Washington, D.C. Make sure your voice is heard, and here's how you do it. All you need to do is go to www.firsthomeiq.com/MBA advocacy. That is firsthomeiq.com/MBA ADVOCACY.
Right.
Well, I'm going to tell you what we're trying to do. So my whole entire career, we've had respite Section 8. I'm talking like it's debatable that I can take Karina, a real estate agent, to a Magic game.
Yeah.
Like if I'm taking Karina to a Magic game, there's nothing educational happening there. And I'm only taking her there because I want her
That's like GMET.
to refer me.
That's like the GMET stuff. The gift, meals, entertainment.
Yeah.
Similar to GMET.
Okay, yes. Right. Like I know this. If I'm a pharmaceutical sales rep, there are very distinct do's and don'ts on what I can do with a doctor's office.
Yeah.
My buddy who's a financial advisor, he has very distinct things that he's allowed to accept or not accept from some of the clearinghouses that he may or may not use when he's placing his clients' money.
Yeah.
Okay. We in the mortgage industry have had similar rules, but I feel like since about 2019, dude, they've been thrown out the fucking window and nobody cares.
Right.
And it's only gotten worse. Because imagine if you got in the industry in 21 or 23 or 25, you don't even remember a world when they existed. Mm-hmm. You may have learned it when you were taking your 20-hour course. You may have studied it to pass your NMLS exam. But then you got in the real world, you're like, shit. Ain't nobody doing that.
Yeah, right.
So I guess I don't have to. And then you get this whole, well, she did it and she's not in trouble. And he did it and look at where his business is. So I guess I need to do it too.
Absolutely.
So what we're doing and what we're seeing on the local side, like this is happening with Veterans United, it's happening with Rocket, it's happening with Zillow, and now they're being sued over it with all these claims and allegations. At the local level, I'm watching branch managers go out, and Mike, you're a real estate agent, and again, I've stated in the past, I've not been able to give you a thing of value for trying to earn your business, right? I could do a lunch and learn. I could bring in a national speaker and invite you to it. I could do events that were educational, but I couldn't just straight up be like, hey, bro, if you refer me 10 people this year, I'm going to take you golfing at name your favorite golf course.
Yeah.
Right? Mm-hmm. Name it Pebble Beach. Right? You couldn't do that.
Right. Correct.
All right. So what is happening now is we have local mortgage branches opening up a satellite branch, going to their favorite realtor and saying, hey, I'm going to make you a non-producing manager and I'm going to pay you half the profits of the branch. But by the way, the only profits coming to that branch are loans that are referred by your real estate brokerage. Mm-hmm. I have friends of mine in the mortgage industry are going to you, Mike, the realtor, and say, hey, Mike, I'm going to hire your wife and she's going to do business development for me. Mm-hmm. And I'm going to put her on payroll. And every time I close a loan that you refer me, I'll make sure she gets paid.
Yeah, that's slippery. Yeah.
It's super slippery. This is what I mean. Like, are we broken?
Yeah.
And what's it going to take? This isn't the world that I'm accustomed to. And I don't want to be that boomer that's like, oh, who moved my cheese? But what I want to do is be that certified mortgage banker that says this shit ain't right. Mm-hmm. We deserve better. We should demand better out of each other as well as ourselves. Or let's take every fucking rule and every fucking regulation and throw it out the window, and it will truly compete.
Yeah.
We'll truly get after it, and only the strong will survive. Yeah. But I'm going to tell you what's going to happen when we do that. You will make less money. I lived that world a little bit. Regulation was a good thing. It was an expensive thing. It was. And don't get me wrong. There's lots we can complain about the regulations that were put in place. We can argue that RESPA is antiquated. It's outdated. It's from 1972. I'm all for having that conversation and making changes.
Yeah, and reform it.
Reform it. I really am.
Yeah.
But I'm going to tell the loan originators that back before LO compensation rules, which we're not even into that topic yet, I will tell you this, y'all made less money per loan, and not just because of loan sizes. Mm-hmm. Like, sure, you make a lot more today per loan because we still get paid based on loan size. But even when I look at what your basis points were, I can go back to 04, 05, 06, 07, 08, 09, and I can pull the data. Y'all were making 55 to 90 basis points, period, end of story. And that was at a time where you could pick the interest rate legally, and the commission paid was indicative to the type of loan that you gave, and it was indicative to how low or how high the rate was and how many points you charged and didn't charge, and whether or not you slapped on a prepayment penalty or you did not. Yeah. Right? Like, that was the wild, wild west days. Consumers overall got better deals. Things were cheaper, definitely cheaper, and loan officers made less money. The problem there is we had the bad apples who were in it for the bunch, and we would have someone putting grandma into a pay option ARM, which is a very exotic loan product for only those that are fiscally savvy, charging her 2 points, making her believe her interest rate was 1%, and slapping on a 3-year prepayment penalty because that's how they made the most money. And it was those bad apples that then forced us to have to do regulation. Like, if the best loan for Mike is a conventional loan with 5% down, I don't need to be convincing him to do an FHA loan because FHA loans pay me double the commission.
Right.
Right? And that's very much what was transpiring. So there's a reason why we have these rules and these regulations, but right now we're not following. There's a reason why I shouldn't be able to pay Karina to refer me, right? Because Karina needs to do what's best in the best interest of her client. Now, the best interest of her client may very well be to call me because I'm the guy she trusts. I'm the guy that's accountable. I'm the guy that's going to give the 3 options and walk them through and hold their hand and show up to closing. However, it can't be a quid pro quo where I then hand Karina money.
Yeah.
Now, people in the 305, and you all know who you are, you think that's how the world works. It does not work that way. That is highly illegal. But, man, the 305 tends to make their own rules, and they do things their own way.
Yeah.
Which is why for most of my career, when it came to running branches and running divisions, I straight up would tell a recruiter who had an opportunity, man, I don't jive in the 305. Just don't. Make up their own rules. They don't follow the rules that are played. The issue is today, it's kind of like that's how the industry is operating. So this is kind of like, you can kind of see how heated I am. Mm-hmm. I'm going to move on to a different topic.
Yeah.
It's under the same umbrella.
Yeah. Let's go.
All right. Under the same umbrella, because it's a trickle down. That's the point I was trying to make. It's trickle down. It starts with with the Zillows and the Rockets and the Veterans United.
Yeah.
But then it leads us to what the big guys are doing that and they're not getting in trouble, then I should be able to hire my realtor's wife and put her on payroll. I should be able to open up a sub branch, whether it's with a builder or whether it's with a real estate agent, and make that person a non-producing manager so I can funnel them basically commission only on the loans they refer me.
Cash on the back end.
Yes.
Yeah, I get it.
Yes.
Yeah.
And then, so while that's transpiring, and by the way, you do have what are called marketing service agreements.
Yeah.
And over the past 15 years, it's been hit or miss depending on what attorney, what administration, who the CFPB director was, whether or not they were safe. Mm-hmm. And that's a true way for a lender to come in and say, hey, Mike, you own the Keller Williams office. I want to pay you X amount of dollars per month to market to your agents and all of their home buyers.
Yeah.
But even then, they got in trouble because it started getting to where it's like, well, I'm only going to pay you if you send me enough business. I'm only going to pay you if I capture enough business.
And you have to actually fill out like the price per lead and all that, right?
Dude, you had to do
there
audits.
Was like a whole,
if done
I've had
right,
to do this.
Yeah, if done
marketer.
right, you had to do audits. You had to be able to show what value. Mm-hmm. I'd have to go to a third party, have a third party do a evaluation. So I couldn't just run in and say, hey, Mike, I'm going to give you $10,000 a month.
Yeah, right.
I'd be like, hey, third party, this is what Mike's office size is. This is how much volume they do. This is how many transactions they do. What is this worth? Mm-hmm. And then that person would say, well, if you get office space plus website space plus signage plus, it's worth X per month. And I can go to you and say, Mike, I want to pay you X per month. Mm-hmm. Right. Yeah. So there've always been legal workarounds. One of those is a true marketing service agreement, but that is audited and that is third party evaluated. And there's always been joint ventures.
Yeah.
Right. And a joint venture is just that. And they're super legal. And you get joint ventures, especially in the builder world, when builders are doing hundreds, if not thousands of units every single year, but a builder doesn't want to necessarily own and start their own mortgage company. So I can go to a mortgage company back in the day. They were called FBC. Today they're called Acrisure. And shout out to Joe Nunziata and his entire team, Jared Veritek, all those guys at Acrisure. They're actually a big sponsor at UCF. It's called the Acrisure Bounce House.
Nice.
Yeah, but those guys do joint ventures amazingly.
Yeah.
Amazingly. And it's where they basically say, look, we're going to front half the money. The builder's going to front half their money. We're going to start a brand new company, 50% owned by the mortgage company, 50% owned by the builder. And I'm not going to get into this on today's episode, but I know plenty of you are going to have this commentary. You'll probably be dropping it in the comments on our YouTube channel that since I've been a young wee lad getting started as an originator 20 plus years ago, we've always had an issue with the builders who own their own mortgage companies and how they steer consumers to their mortgage company and say, you only get these crazy incentives if you use. And I wish that would have gone away 20 years ago, 10 years ago. It hasn't. I ain't got the breath left.
You mean like the builder's preferred lender, but it's the builder?
It's the builder. Yeah. And it's like, Mike, you get $10,000 of your closing costs paid if you use my lender. Right now it's, hey, Mike, if you use my lender, I'll honor a 4.99% interest rate.
Yeah.
Right now, the only way that's being done is that you, the builder, have paid me, the mortgage company, $50,000 up front off the closing statement.
On the back end.
Yeah, on the back end, behind the scenes, so that I can sell you super duper cheap interest rate so that you can move product because you determined.
Some mafioso stuff.
If I drop the sales price $50,000, it only saves that person $300 a month.
Yeah.
But if I drop the interest rate 2 percentage points, it saves them $800 a month.
Yeah.
Well, what's going to move product? The payment being $800 cheaper or the payment being $300 cheaper, right? You're going to take the $300 cheaper all day long.
All day.
Right? So we ain't got time for that. And just for the record, I want people to know, I, as Dustin Owen, I wish that would have been solved for 10, 15, even 20 years ago. It hasn't. And right now it's not even the crosshairs. But the things that are in the crosshairs, loan officer compensation.
Yeah.
So you might not know this, Karina, and Mike, you know a little bit because you've heard me talk about it. Since the Dodd-Frank Act, which was what happened after the financial crisis, Dodd-Frank Act, I believe, 2010, loan officer compensation changes happened right after that time frame.
Okay.
It specifically states that a mortgage loan originator cannot get paid any more or any less based on interest rate. Period. End of story, guys. Period. End of fucking story. That's what it states.
10% interest rate versus a 4% interest rate. LO gets compensated at X regardless.
Whether I get paid a base salary plus $100 per file.
Yeah.
Whether I get paid 100 basis points.
Right.
Like it doesn't. Now you can pay me different if it's a purchase or a refi.
Yeah.
You can pay me different if the lead came from a past client who already has their loan with me, or you went out and you found it on your own.
Mm-hmm.
Right. So Mike, you own a bank. You're like, hey, Dustin, if you do a loan for a bank client, I'm only going to pay you 50 basis points.
Yeah.
But if you go out and you find your own client, I'll pay you 100 basis points.
Yeah.
Cool. Right? Like you don't have to pay me as much when they're already a client. You're willing to pay me more if I'm bringing you a brand new client.
Mm-hmm.
But you could not pay me any more or any less. If I did an FHA loan or a VA loan, and both those loans were for $400,000 and my comp plan was 100 basis points.
Yeah.
You had to pay me 100 basis points.
Yeah.
Doesn't matter if it was FHA or VA or conventional, even for a down payment assistance loan that pays the least amount of money gross to the company, they still had to pay me.
Yeah.
Okay. There are flaws with that.
So that's this act, though, that put that in place.
LO compensation rules have not changed since the Dodd-Frank Act, and that was in 2010, 16 years ago.
But prior to that?
Oh, prior to that,
Wild West,
homie.
Yeah, okay.
Well, but I'm going to tell you, in the Wild West, 80% of the consumers got better deals, and lending was cheaper. 20% got raked over the coals and screwed. So what happens with any regulation? This is a good lesson for the kids at home. Here's what regulation does. It protects all and makes it more expensive for all. It takes the pain of a few, spreads it out amongst the group, and puts handcuffs and guardrails so that nobody gets totally hurt.
Yeah.
Right? It's like, hey, everybody's going to get robbed, but I'm only going to take your candy and your Swatch watch. No one's taking your jewelry and your diamond rings, right?
Yeah.
So these are the rules. Dude, where we sit today, I just saw someone on Instagram, and he has a hell of a following on Instagram. And this is where I know, in my experience, we're broken. Mm-hmm. This dude is acting like it's 2004 all over again. I've been there with the pinky rings and the slick back hair. They were called subprime reps. This guy is advertising and marketing his commissions.
Yeah.
Okay. The commission's great. That's not why we do this. The commission's great. It's not why we do this. And he is blatantly being like, yeah. And he's very much like, bro. He's like, if you think I'm a bro, this guy's like through the roof. Mm-hmm. And it's, yeah, so my team, it drove this much revenue. And listen, dog, if you can't, all you got to do, man, is just lower their rate and make less revenue, make less money and move on. This guy is openly saying this. Now I'm going to tell you about the industry. Everybody. I know everybody's a strong word.
Everybody in
the club's getting tipsy.
Yes.
Yeah. Everybody in the club's getting sideways with not following LO compensation rules. And my wife would tell me, using words like all, everybody, they're super strong.
Yeah.
I'm sure it's not everybody. There's going to be a carve out.
Yeah.
But the majority of lenders out there, IMBs, brokers, some banks, 100% right now, and have been. I mean, I reached out to CFPB about this 4 years ago, and to see if they had it even on their radar. The NBA has it on their radar, but nothing is being done about it.
Yeah. And so they didn't offer guidance back when you inquired.
They were clueless.
That's crazy.
I spent 2 hours on the phone with someone higher up in CFPB trying to explain to them their own rules.
Wow.
And that's when the CFPB had teeth.
Yeah.
They ain't got no teeth. It's been defanged since the new administration came in.
Yeah.
So, but what's transpiring right now, and people are so just oblivious that they're anti and going against the rule, that they're talking about it openly on social media platforms and using it as a recruiting tool and an educational tool. You are not allowed to give someone a cheaper interest rate and therefore take a lesser commission. The industry does it. Left and right, the industry does it.
That's wild.
Compliance people are looking the other way. Their attorneys are looking the other way.
Wow.
Maybe the attorneys are giving them sound advice, but the leaders are saying this. But if I don't do it, I'm going to lose. If I'm going to do it, I don't stay in business. If I don't do it, my LOs will quit. If I don't do it, I can't recruit that branch. That's what I'm talking about. We're broken. It's going to take someone stepping up to the plate saying, you're in trouble. I'm fining you. I'm putting you out of business, and you just pray to God it's not you.
It's going to be the loan officer podcast. Everybody watch out.
What's that?
We're going to whistle blow.
Fuck,
Every
no, we're
one of you.
not. No way.
Totally kidding.
That's the last thing I need someone to think
I'm
that's going to
totally
happen.
kidding.
No, I rely on this industry to provide my family.
Mm-hmm.
I may do an episode like this because I care, and maybe I care too much.
Yeah.
Right? Maybe I care too much. And yes, I would love for there to be clarity.
Mm-hmm.
We either got to enforce the rules we got or get rid of them.
Right.
I can argue both sides, and I'm probably good on both sides.
You
I
just
really
want it to
am.
be consistent one way or the other.
I want a level playing field.
Yeah.
I want everybody to be able to prosper, everybody to be able to profit, everybody to be able to do well.
I get it.
And there to be clarity. There's nothing worse than having rules that aren't followed.
Yeah.
There's nothing worse than having guidelines that this group is willing to break at a level 3 out of 10. This group's willing to break them at 5 out of 10.
Mm-hmm.
These two guys are crazy ass kamikazes. They're breaking these rules at 10 out of 10. And there's still some people playing by the rules.
Yeah. I'll break it 0 out of 10 and be the one that gets in trouble.
Well, you wouldn't get in trouble if you're 0 out of 10,
Well,
right? You may get audited, but here's what people have to understand. So you have to understand if you are openly stating
Yeah.
that, all I do is just lower the interest rate, take less commission.
Mm-hmm.
I just want you to go back and study LO compensation rules and ask yourself, how is that even allowed? How is that even legal? But then I want you to really think about and contemplate what would happen if you were the one. Because here's what's going to happen. Let's say the CFPB,
You lose your license.
you get fined. The companies get fined X amount of dollars per occurrence.
Yeah.
Oh yeah, it's punitive.
Yeah.
Super punitive.
Absolutely.
Lose your license, lose your livelihood. And for some of these people, maybe they don't care. Maybe it's like, look, dude, look, dog, not my problem. Right?
Yeah.
Not my monkeys, not my circus. I'm a sales rep. I'm a sales dude. And whatever you need me to sell, whether it's cars, whether it's credit cards, whether it's collections, whether it's mortgages, man, I'm just going to grip it and rip it.
Yeah.
Smile and dial, turn and burn. Man, those people make this industry, you give it a bad look. We got rid of them back in 06, 07. We weren't trying to let them get back.
Mm-hmm.
But it seems like and appears like we're getting more and more of that, and everybody's a part of it. Everybody's a strong word. Majority of the people are a part of it. But if you think because she wasn't called or that company's doing it so I should do it, it's like playing a game of chicken.
Yeah.
It's like playing Russian roulette. Eventually, you are going to be that person where when you spin that revolver, that bullet's in the chamber as you click, right? And it's your brains that are all over the wall.
Yeah.
And
You're saying Russian roulette type of deal.
yes. Yeah. So, but the last thing I'd share on this topic is this. Just because the CFPB is not around does not mean that the state regulators aren't around.
Mm-hmm.
And you got some states that are way more punitive in consumer advocates than the CFPB ever was.
Yeah.
And many lenders at this standpoint operate in many states. You get one state, let's say the state of Idaho, doesn't like something. Guess what? The minute they go in and they don't like something and it makes national news, all the other states are going to start looking at your books too. Because they don't want to be one-upped by the state of Idaho.
Yeah.
It's only a matter of time. And once it's a matter of time, then we all have to make that corrective change. So, there's that. This episode is running super long. Where are we sitting on time right now?
We're at 40 minutes.
We're at 40 minutes right now. Okay, I need to find a way to
How many more do you got? Like one more hot piece on
I'm
this?
going to spend 10 more minutes on this.
Yeah.
Yeah, I'll spend 10 more minutes.
I'm loving it.
Yeah, do we need to pay any bills real quick? You know what?
Yeah.
Let's slide in. Let's slide in a word from one of our advertisers. Then we'll come right back. Check this out.
If you're a licensed originator who's closing loans, but you're not consistent, this is for you. If you're brand new or just looking for motivation, trust me, this is not for you. Most LOs don't need more information. They need structure. They need proven processes and somebody to hold them accountable. T-Lob's Originator Coaching gives you weekly live coaching, scripts top producers actually use, and step-by-step business systems you can implement immediately. Not someday, we're talking day one. You're not watching videos alone. You're executing in real time with other originators who take this seriously. Right now, you can try it free for 2 weeks. That's 2 full weeks for free. You'll sit in on live coaching calls. You'll get access to the frameworks and see exactly how top producers run their business. If it creates clarity, if it creates momentum, or even if it puts wins on the board, you keep going. If it doesn't, no worries, you can cancel. No pressure at all. Click the link, start the 2-week trial, and finally, build this like a business, not a side hustle.
All right, so we got 10 more minutes. I made a statement earlier that if you're a mortgage loan originator right now, 2026, you are, this is factual, we got the data on it, you're making more money per transaction than you ever have. Fact. You're doing less transactions per originator than you ever have. Fact. Mortgage companies are still making the least amount of money than they've ever made while taking the greatest amount of risk than they've ever taken. 4 facts right there. I'm just going to tell you, if I'm sitting in your seat, none of that makes me feel good. None of that makes me feel good. Now, guess what? There's nothing I can do about it. We did an episode on what's happening over in Iran and how it's going to impact the mortgage industry. Yeah. And I said in that one, like, look, nothing we can do about it.
Right.
But we can be aware of it. We can understand it so we can explain it. Well, in this case, there's nothing you can really do about the fact that you're making what you make. Don't get me wrong. Like, I'm jealous, hella jealous. Right? I wish I was making that much money per transaction. I mean, my first breakout year, I literally did 124 transactions for $26 million, and I made 55 basis points. And that wasn't consumer direct. I was like legit. I went out and built that book of business, purchase focused, realtor referred. Yeah. That's just how the industry operated. My average loan size was 240. Today it's like 360. In some markets it's 460. And, we were only making 55 basis points. That's what you got paid to go out and self-source. It was all tiered. It went 40 bips, 50 bips, 60 bips, right? And up to 70 if you did something crazy like $3 million in a month. But I averaged that year about 55 basis points. So yes, some of it maybe is like I'm hella jealous, but I'm going to tell you this. From being in the rooms that I get to be in, from attending the conferences that I attend, being a part of the dinners I'm a part of, the happy hours, the friends that I've made over the past 20 plus years, that's not going to last long, right? You got to be focused on units, and you have to anticipate a time in your career where your commission per loan drops. AI advancement, technology, robo this, agentic agent that. It's just going to happen, right? You can focus on what you can control, your attitude and your effort, and your attention to detail. So I'm encouraging all originators, continue to push out your personal brand. Continue to be the source of information in your market. Continue to be the most known person who people can rely on when they need a mortgage. However, expect your companies at some point to expect you to have to start doing 3, 4, 5 units a month consistently. Expect at some point you're not going to be able to make $10,000 per loan, right? You're not going to be averaging $6,000 per loan, right? That number may come down closer to $4,000 or $5,000 per loan. And you should be thrilled with that, right? I'm not saying you're not going to be able to make $200,000, $300,000, $400,000 a year. I'm not saying you're not going to make $1 million a year. You will, but it's going to go back to, if you want to make $1 million a year, you got to do 300 or 400 units per year. Yeah. You want to make $400,000 a year, you got to do 120 units per year. It's no more of this, oh, well, I did 60 units for, 24 million, and at my comp plan, I made $400,000. And by the way, 60 units, the way things are being told, you'd be a top producer, right? When I got in this industry, 60 units, you didn't even crack President's Club. And I know I sound like a boomer when I say that, but that's just a fair warning and a heads up. I'm cheering you on, right? I want y'all making the most amount of money, because I promise you, that's more money you can spend when you come on the T-Lob cruise in September. That's more money you can spend when you join T-Lob's Originator coaching. I want you fools making a ton of money. I want to be hella jealous of you. But as your mentor, as an elder statesperson in this industry, I just got to kind of point out what should be like the elephant in the room, or what Captain Obvious could have shown you. What it is, this isn't going to last for long. I don't know if it's going to be a year or 3 years, but sometime between now and 2030, the landscape's going to look a lot different. So I hope if you're making a ton of money, you're banking a ton of money, you're investing a ton of money, and you're taking advantage of this. Or I hope you're like, well, it's great while it is, but behind the scenes, I'm going to work on plan B, because I love this industry. I want to continue to support it and support my community. and therefore be a part of it.
And I think engage with this episode in the comments, right? Like you're
dude.
You're a comment warrior. So Dio will answer all the comments for this episode, but engage with it, whether you agree, disagree. Is he a boomer?
Yeah.
Like, tell us.
Be nice. I mean, don't hurt my
Yeah,
feelings.
but it'll
Don't
be
get your
fun.
way to hurt my feelings.
It'll be
but-
fun. Yeah, don't be mean.
Yeah, I mean, if you are, I may be mean back, but that kind of, it's good for the algorithm.
It's
So,
good.
hey,
Yeah.
you're not going to hurt my feelings. But yeah.
Yeah, let's start a dialogue. I mean, it'll be fun.
Yeah, in a nutshell, so this is what I wanted to cover in general. The one thing we didn't touch on,
Yeah.
and I'll spend a second on it.
Yeah, let's do it.
Y'all, I have never in my life seen the amount of money being thrown around to attract talent. I mean, right now, Karina, if you are a mortgage loan originator and you're doing $15, $18 million in volume, there are companies that are going to come in right now and offer you $120,000, $150,000, $180,000 to have you leave your company and come work for theirs. But in return, they want you to sign your life away for the next 3 to 5 years, right? That's called a clawback,
Yep.
right? If I give you this money up front, Karina, and you come work for me, but you want to quit and go work somewhere else, if you quit before 3 or before 5 years, you owe me all that money
You got to
back.
give the money back.
Yeah. And
But you can, most of the time, they're trying to get your book of business to go with you, right?
yeah, they are. I mean,
yeah.
look, I have my personal brand. I have my following.
Yeah.
There's certain realtors and builders that know how to get a hold of me. There's certain consumers that know how to get a hold of me. I can go into Redder and I can pull up my entire list
Yeah.
of everybody that I've ever done a loan for.
Yeah.
And then I can use public data to then create a lead list and I can market to them. I may or may not get a nasty gram or a nasty letter from my previous employer. My previous employer sent me some nasty grams. It's never fun. It's usually a scare tactic. You kind of roll with the punches and move on with it. But my concern is more of this. The amount of money that's being thrown around and then what is being asked by the originator.
Yeah.
I'm just worried about it. I just don't like it. Something just smells like fresh manure, and not the manure like you like to smell because you love going to like the barn and ride horses. Like this is like rank bullshit, you know? And it's a little bit worrisome. It's a little bit scary. I can't imagine it's sustainable. I really can't imagine it's sustainable. And I still would call this another game of like Russian roulette or another game of chicken, a game of mercy. Somebody's going to have to like cry uncle first. But I'll tell the originators, before you sign something like that, consult a mentor. If you need a mentor, we have a free service. It's called TLOPS Career Advisory. We're launching it this month officially. I've been talking about it for the past 3 months. We're officially launching it. We're rebuilding our website. It's going to have placement there. I've already helped a dozen LOs right now.
Yep.
I actually helped an originator negotiate. He showed me his offer letter. I was like, bro, take it back, ask for this, do away with that. A day later, bam. It was a stronger offer. It was more in his favor.
Yeah.
I had someone help me determine, do I leave my company after 10 years or do I go take this job as an area sales manager? Look, I didn't place him. I didn't convince him to leave. He was already leaving or not leaving, but I gave him that mentorship, that sounding board. Like I didn't make a dime on either one of those. Another guy called me and goes, hey, I think I should leave my company. I said, why? And we did a discovery call. He likes his company. His company supports him. I actually know his company. His company's a good company.
Yeah.
They're not a client of ours, at least not yet. But long story short, here's what I helped him do. I go, you don't need to leave. What you need to do is get off that tiered comp. You're a top producer. Dude's doing like 40 million. Get off tiered comp. You don't need to be on tiered comp. Tiered comp's for low producers. It's not for top producers. Also, at your production level, you can probably negotiate that the company supports you in hiring a loan officer assistant and they pay for the bulk of it. Right? All of a sudden, the guy didn't have to make a move. The company kept a $40 million producer. They don't even know this existed. They owe me probably a really nice thank you gift if they knew I did this for them.
Right.
But I'm not doing it for this. I'm doing it for the originator, for the branch manager. And look, occasionally when you call me for advice, I may try to sell you coaching. True story. Some of you need it. Some of you don't. You have enough free coaching by subscribing to my YouTube channel and signing up for my newsletter, right? There's enough free there. In fact, if you're not subscribed to the YouTube channel, okay, we have 600 podcast episodes, but you know what else we have? 400 coaching and training videos on that YouTube channel. So you got to go to TLOP Entertainment YouTube, subscribe because there's tons of free coaching.
Look at the playlists.
Yeah,
There's
look
a
at all
lot
the
of different
playlists. Yeah, we have Coach's Corner, we have Mortgage School, we have the DO Show, etc. In the newsletter, you can go to my website, tloponline.com, and you can actually sign up for the newsletter. It goes out every Thursday. I'm always giving a market update, a sales tip, a marketing idea. But more importantly, I invite you to one free masterclass as long as you get my newsletter, you get the invite to the free masterclass. So there's plenty of ways that you can like learn for free.
Absolutely.
But if you're calling for career advice, I'm going to give it to you. And yes, probably 1 times out of 7, I'm going to suggest, hey, you should look at our launch program. And I'm going to talk about all the success we've had with launch, or, oh, you'd be a good fit for our coaching community.
Yeah.
And then there's probably 2 times out of 7, Mike, true story. It may make sense for you to make a move. Mm-hmm. It may. And if it is, I would love the opportunity to introduce you to some of the best leaders I know of in the industry, because I've made it my point to not only be one of the most influential people in the mortgage industry, but also to know all the influential people. And a lot of times it's about the leader you work for, not the company you work for. And I can match you with a really good leader.
Yeah.
These are all things that we do. So just be careful out there with the crazy sign-on bonuses. Be careful with the crazy clawbacks. Make sure you know what you do, and make sure you know what you're signing your life away to. Mm-hmm. Read the fine print, ask questions, push back, and when in doubt, reach out and know that we're here to help. Y'all, thank you for all of the time. I've been wound the fuck up about this for at least the past month.
You got it off your chest.
Well, this was about 5 years in the making. I've been wound up by LO compensation since about 2020.
Since about
2021. The clawbacks and the
and the
offer letters. That's been really weird the past 3 years. Mm-hmm. Obviously, the lawsuits are the lawsuits. And then like this new phenomenon of quote unquote legally, and that's, I say that loosely, legally paying realtors and builders by putting them on payroll to send us business. I don't like it. It doesn't smell right to me. And I think there will come a time that we're going to see a reckoning. And I think until then, our industry is a little bit broken, and I don't see it fixing itself. I see it's going to be some kind of a event happening, a lawsuit won, a massive regulatory enforcement action, not by the CFPB, but by several states.
Yeah.
And I think that'll slowly start to put our industry back in check. But the pendulum has 100% swung the wrong direction, and it swung too far.
Yeah.
Mike, Karina, any parting shots, any parting comments?
No, I mean, what you just said, the pendulum has swung in the wrong direction, but the pendulum always swings back eventually. So,
that's the goal. I mean, that's the goal. The goal is we don't want the pendulum too far left. We don't want it too far right.
Absolutely.
We want that thing in the middle, and it just sways briefly in the breeze. Right now it's taking more of like a hurricane-esque massive swoop, and it swooped the wrong direction. So stay tuned. Keep grinding, y'all. Heads down, blinders on. Control what you can control. That's your attitude and your effort. She is Karina Mojica. She is our producer extraordinaire. He is Mikey, Rocky, Vinny. He's my business partner. We call him Marketing Mike. Real name Mike Siciliano. And I'm Dustin Owen, the creator and host of the Loan Officer Podcast. That is all the time we have for you today. We look forward to catching you on the next episode. And remember, sharing is caring. If this episode resonated with you, share it. Give it a 5-star review. And if you're on the YouTube channel, make sure you click subscribe and get crazy busy in the comments. Let's have some fun, y'all. Take care. Peace.